Right now, as you're watching this video, the biggest financial event in human history is quietly unfolding around you. No headlines are screaming about it. No breaking news alerts. Just a slow, steady, unstoppable transfer of $124 trillion, moving from one generation to the next. That's $124 trillion. To put that in perspective, that's more than the combined GDP of the United States, China, and the European Union. And most of it will change hands before the year 2048. This is the great wealth transfer. And whether you're expecting an inheritance, planning to leave one, or never even thought about either, this shift is going to affect your finances, your investments, and your future in ways you probably haven't considered yet. Let's break it all down. The Great Wealth Transfer refers to the unprecedented movement of assets from the baby boomer generation, and even older Americans from the silent generation, down to their children and grandchildren. According to research firm Cerulli Associates, by 2048 roughly $124 trillion in assets will have changed hands. That number was originally estimated at $84 trillion just a few years ago. It's already been revised upward, because the assets themselves have grown so much. Since COVID-19, stock market values have jumped over 27%. Real estate values are up 39%. The boomers got richer while they were aging, which means the inheritance pie just keeps growing. Baby boomers alone are expected to pass down $84.4 trillion. That's 63% of every dollar being transferred. The silent generation, those born before 1946, will add another $15.8 trillion on top of that. So who gets the money? Let's talk about the actual numbers by generation. Generation X, people born between 1965 and 1980, stands to inherit $39 trillion. Millennials, born between 1981 and 1996, are in line for $46 trillion. And Gen Z, those born after 1997, are looking at $15 trillion. Together, younger generations will receive roughly $106 trillion of the total transfer. Now here's where it gets really interesting. A February 2026 Fortune article highlighted what financial analysts are calling the peak 35 phenomenon. Millennials are now in their peak earning and inheritance receiving years. Their total net worth has exploded, from $3.9 trillion in late 2019 to nearly $16 trillion by the end of 2024. That's a 4 times increase in just 5 years. And the pace is only accelerating. In 2026 alone, approximately 4 million baby boomers are turning 65. That's 4 million more people entering the age range where estate plans are being executed, trusts are being activated, and property is being transferred. But before you start mentally redecorating your parents' vacation home, there's a critical reality check you need to hear. There is a massive expectations gap when it comes to inheritance. A full 1/3 of millennials say they expect to receive a meaningful inheritance from their parents. But here's the catch, only 1 in 5 baby boomers say they actually plan to leave one. That's a 13 percentage point gap between expectation and reality. Why? Because rising healthcare costs, longer lifespans, and retirement expenses are eating through more of boomer wealth than any generation that came before. Many boomers are spending their assets simply to live comfortably for 30 or more years of retirement. The lesson here is brutally simple: do not build your financial plan around money you haven't received yet. An inheritance is a potential bonus, not a retirement strategy. Now, let's talk about how the wealthiest families are actually moving this money. For the top 10% of households, who will account for roughly 42% of all transfers, or about $35.8 trillion, it's rarely just a check arriving after someone passes away. The wealthy use trusts, charitable foundations, Roth IRA conversions, annual gifting strategies, and family-limited partnerships to transfer assets efficiently, often while they're still alive. The strategic use of estate planning tools can save families millions in taxes and ensure assets go exactly where they're intended. For the middle class, it's usually simpler, a combination of real estate equity, retirement account balances, and life insurance proceeds. In fact, Gen X and millennials are expected to inherit $4.6 trillion in real estate alone over the next decade, with more than half of that happening in the United States. And what are younger generations doing with money they're receiving? The data here is fascinating. According to a Bank of America survey, 72% of Millennial and Gen Z investors believe it's no longer possible to generate above-average returns using only traditional stocks and bonds. So they're diversifying into cryptocurrency, private equity, direct investments, real estate, and even funding their own startups. Inherited wealth, for this generation, is becoming seed capital for an entirely new approach to building more wealth. But let's not ignore the shadow side of all this. There's a troubling wealth concentration story buried inside the Great Wealth Transfer. Just 1.5% of all households control 42% of the assets being transferred. That's $35.8 trillion flowing to families who are already wealthy. This means the transfer doesn't just move money across generations, it amplifies existing inequality. The gap between those who will inherit something meaningful and those who won't is likely to get significantly wider over the next 25 years. Understanding this dynamic matters, because it affects everything from housing prices to investment market competition to the political landscape around taxation and estate law. So what should you actually do with all this information? Here are 5 concrete steps to take right now. First, have the money conversation. Whether you're a boomer with assets to pass down, or a millennial hoping to receive some, have an honest, direct conversation about expectations and plans. Assumptions on both sides cause avoidable family conflict and financial losses. Second, get your own estate planning basics in place. Even if you don't have $1 million, you need a will, a beneficiary designation review on all your accounts, and potentially a basic trust. Don't leave your family guessing. Third, if you do receive or expect to receive an inheritance, treat it as an investment opportunity, not lifestyle inflation. The wisest heirs use inheritances to eliminate debt, max out tax-advantaged accounts, and buy income-producing assets. Fourth, diversify across asset classes. Younger generations are right that the old 60/40 stock and bond portfolio isn't the only option anymore. Talk to a fee-only financial advisor about whether alternative assets make sense for your situation. And fifth, understand the tax rules. Inherited assets often receive a step-up in cost basis, which can mean significant tax savings. Roth conversions, gifting strategies, and charitable giving can all be powerful tools, but only if you understand how they work before the money arrives. The great wealth transfer isn't coming, it's here. $124 trillion moving across generations over the next 2 decades will reshape investing, real estate markets, consumer behavior, and the American economy in ways we're only beginning to understand. The question isn't whether this transfer will affect you. It will. The only question is whether you'll be prepared. If this video helped you think differently about your financial future, hit that like button and subscribe, because we cover exactly this kind of big-picture personal finance every week. And drop a comment below. Are you expecting an inheritance, or are you on the boomer side planning to pass one down? I'd love to hear where you're at.